Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Hi, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening each week. Hey, if you want to see us and hear us, go to YouTube, Jeff Barton, the Mortgage Voice. You can see us there and hear us there. We have hundreds of shows that you can see. Also, we are on many different podcasts, and those podcasts can be heard. Daryl, do you have a list of those podcasts?
I sure do, Jeff. We've got podclips.io, YouTube, radio.com, iHeartMedia, Stitcher, Spreaker, Spotify, and, of course, Apple Podcasts.
Excellent. Also, if you want to hear, see us, anything about what we do at the show, give us a like on all these particular devices that you will hear or see us. Why? Because the more people see us and hear us, the better the show gets. And the more people we reach, the more people we can help. I'm Jeff Barton. This is the Mortgage Voice. And again, thanks for listening. Let's get right to the news to use section. I like to jump in and just give you some information right off the bat. Mortgage interest rates. Now, they fluctuate and have been fluctuating on the upside for about a month. We did receive some obviously stressing news with the new COVID variant. Daryl, what's that new COVID variant name?
Odessa or something?
No, it's Omicron.
Omnifid.
Yes, exactly. So if you are one of those wary people, and there are many people, and certainly anybody in the world of finance gets worried very quickly, and it's always about what ifs. It's never about what is. But that is the future and what we look at in the financial area when we're talking about especially interest rates. Any hint that there's more risk than less risk, you're going to get an interest rate hike. So we've been in that for quite some time now, about a month. And then with this new particular variant, the opposite happened. Why? Because foreign exchange money flowed into U.S. equities, thus driving the cost or the price of the 10-year down. So let's get into it. The 30-year fixed rate loan, 3.21%, 2.60 for the 15, 2.85 for FHA, 3.13 for the jumbo loan, and 3.33 for the 5/1 ARM. And as I said, we had been flirting with 1.7 in terms of the yield that you would get on the 10-year. Well, now it's down to 1.43, 1.44 today. And that demonstrates to you that if, in fact, we have news that would send equity markets around the world scrambling for a safe harbor, well, they always go to U.S. Treasuries. Even though it was funny what Yellen said today before the Senate subcommittee, listening to her and Fed Chairman Powell talk about the economy and the different phases of how they're going to help quash the inflation that's been happening, as well as, the debt limit. Yeah, she said, look, we don't get the debt limit done, and I don't know why we don't do. I think Jamie Dimon had it right. He's the head of Chase Manhattan. He said, why do we even have a debt limit? What's the purpose of it? And I think at one point when, and this is back to my Yankee roots, which I particularly agree upon, never spend more than you make. How many times have you heard that? Well, the U.S. government hasn't done that for a generation. So raising this debt limit, the debt limit used to be, okay, we're approaching it, let's cut back on spending, let's tighten our belts, that sort of thing. But especially with a thing like COVID, especially with the last 10 or 15 years of crisis after crisis, financially or economically, or a disaster in the world, weather or something like that, it always requires the government to add stimulus. And stimulus means printing money, giving it out, making it easier to get, and they certainly have done that in the mortgage interest rates. Now we're going to see them probably go up, but as I said, we have had them come down because the new Omicron variant has driven equities around the world, driven money around the world to U.S. equities, which has, again, driven the 10-year down. But interest rates, still pretty good. I mean, you look at that 30-year fix hovering at 3%, a little bit over, a little bit under, it's over now. That's a smoking loan. If you're out there, which, is probably why we've seen pending home sales jumped last month to 7.5%, up 7.5%. Now we're down year over year, but when we were considering the way that new home sales were going down and existing home sales were going down, we were seeing a pattern by which we would have more inventory on the market and therefore prices would eventually go down. This number belies that fact. And as the article that I read said, look, the reason that is because people were afraid interest rates are going to go up. So therefore, they jumped into the market and bought whatever they could for whatever interest rate they could get at the time, thinking, of course, that we were going to see a much higher interest rate. Boom, Omnicore or Omnicon or whatever it's called, variant comes along, the interest rates go down. So as we are, always looking for the next thing that's going to indicate where rates are going or the next thing that's going to indicate what the government regulators are going to do, it's always the thing that you least expect. Now, we were all, and especially in the U.S., tired of the Delta variant, the COVID virus. 100% everyone's tired of it, and they're ready to get back to normal. And in a survey they did that I think I talked about a couple weeks ago, 70% of the U.S. People who were surveyed said, look, we're already back to what we were doing before COVID. And that meant going to theaters, going to out to dinner, going to sporting events, just going out shopping, just going out. In a lot of states, they don't require masks. A lot of states, they don't require vaccine cards. It's only in the eastern and western seaboards that you might find that. But certainly everything in the middle, not like that. I was in Denver recently. Yeah, you might find 30% of the people wearing masks, but most of them, no. Same thing in Atlanta, Georgia. Same thing in, just a lot of different places that we do business. And in all of these places that we do business, it's really dependent on the consumers wanting to spend money. The consumer sentiment index is really down, and it's down because obviously it was taken right after this omnivore or Omicron omnivore. You know what an omnivore is?
Somebody that eats meat.
Yes, it is.
And plants. And plants.
Plants. It's a plant eater, right? So, no, we're not plant eaters, but in regards to the Omicron, the Delta variant, it's really, and I said earlier today, we put out a video. We do that on LinkedIn, and we do it on Facebook and a bunch of other places. And we do it about 2-3 times a week. We try to keep our local listeners, the people who follow us. And by the way, if you want to follow us, it's a great idea. At Jeff6493, that's my Twitter handle. And that's a great place where I put out some daily musings about what's going on in the economy. Today is like COVID is everything, right? Whatever COVID says, COVID does, So if COVID says we're going away, then we're going to start getting back to some normalcy. Then we're going to have other influences affect both interest rates and the availability of money. However, since this virus is not going away, what we're seeing is, yes, it's volatile. We don't know what's happening because at any moment we could get either a new vaccine. I know Moderna came out today and said, look, we're going to have a new Omnicore vaccine out by February, meaning that they're going to take into account the totality of the new variant and come up with a virus. And as my buddy, a guy was on the show a couple weeks ago, Tim O'Keefe, he said, oh, boy, this is going to be, I had no idea. What we really meant to say was going to take 3 vaccines. And I, of course, hit him back with, no, this is a monthly thing. Every month. It's like cereal in the morning. You're just going to take a shot every morning now. It's just ridiculous. But again, it does rule the roost when it comes to both your interest rate that you want to get for your particular loan and the availability of funds. Now, the availability of funds, what's happening with that? Biden administration, they are taking a very regulatory approach to a lot of things. They've installed, as everyone knows, a Elizabeth Warren devotee at the CFPB. And today it was reported that Richard Caudry, who used to be the head of the CFPB, is now going to be head of federal banking authorities, federal banking regulators, and this is what Biden is. I think it's his ode to the wing of his party, which wants to, not vote for certain things because they think they're too conservative. Well, in the financial area, obviously Elizabeth Warren, who helped write Dodd-Frank, who helped install the CFPB director originally, she'd be into this, so maybe this is the quid pro quo, or you do this and then you vote for that. I don't know. But is it good for the markets if they make it more difficult on lenders, i.e. there will be more regulatory scrutiny on them. I don't know. I think a lot of times what that does is it kills the momentum of any market to make money, i.e. They have to spend more money trying to prevent audits from wrecking their business. I'm not saying they're not worth it, but as everyone knows, the front end of all these loans is pretty good. FICO scores are, above 700. And you got, in most cases, a good percentage down, and you've got equity rising in the properties on the backs of these good loans. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We're going to see you right back a little later on in the show. Got a great show lined up for you. And as I said, we'll be right back. This is the Mortgage Voice, and we are available on demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately on YouTube. Hey, we upload the show every week, and every week you can go there and find it. We shoot it for video, and we have audio. Just search for the Mortgage Voice, and you can also listen to the show on demand on your mobile device via any of our podcast partners, Apple, Google, Spreaker, IO Clips, Spotify, Stitcher, and more. Plus, we are still available on traditional radio. That's right, I love some radio in a number of different markets, including those in the Inland Empire, California, Las Vegas, Albuquerque, New Mexico, and Lake Tahoe. So tune in. And again, I'm Jeff Barton. This is the Mortgage Voice, and thank you for listening. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and thanks very much for tuning in, listening to us. And if you want to listen and see us, we have so many ways that you can do that. And every time I ask you to go to these places, whether it's our podcast, whether it's YouTube, whether it's the radio stations, whether it's on LinkedIn or Facebook or any number of these places, make sure you click on that you like us. You like what we're doing. Why? Because the more people do that, the more people we can get the message to. That's the way it works, especially today. And we're going to have on a terrific guest later on in the show to explain a little bit about that. However, right now we bring back to the show Reed Blake, who's been on several times, talking about some unsecured business capital. He works for Foresight Funding Advisors. And Reed, welcome back to the show.
Thank you, Jeff. It's a pleasure being back on.
Okay, excellent. Last time when we were talking, you did mention the fact that there's a couple of different ways that your business lines of capital can be accessed. We've had some issues with COVID, businesses starting and stopping. One, what are those lines and ways to access it? And two, have you been really affected by COVID that much?
The answer was initially we were, but the types of funding that we do, those markets are pretty much back.
Right.
Underwriting has changed a little bit on the unsecured business lines of credit since COVID, post-COVID. But other than that, the unsecured cash loans and the real estate line of credit will be crushing it. Yeah, absolutely.
Excellent. Okay, tell us about business lines of credit. How does one get it? Where do they go to get it? All that stuff.
Okay, great. An unsecured business line of credit is a line of credit. We call it forever money. Just keeping the math simple, let's say you get a $10,000 limit. You can draw down $2,000, you pay it back. Draw down $3,000, pay it back. Draw down $4,000 and $2,000 for different things you're doing, make monthly payments, all that kind of stuff. It's forever money, resets every year. The interest rates are just whatever the market rates are at the time. They're not rapacious. Then the second category are unsecured cash loans. And this is where we've been really having a tremendous amount of success. They're unsecured. You can use them for any purpose that you want within real estate, your skin in the game money, your earnest money, your down payment, your whatever, if you're working with hard lenders, etc. We have one that's a general purpose, and one category. We have about 80 relationships, and they run from about $25,000 to a maximum of about $350,000.
Okay.
We have another one that we call the specialty loan. It's really distinct in the sense that it will be anywhere from, again, around $25,000, $30,000 on the low end to up to $500,000 on the high end. And what's really amazing about this particular loan is it does not, let me repeat, does not report to your personal credit report. Someone may have a $200,000 cash loan that they're using, they're deploying that capital to grow their business.
Right.
And it's not showing up on their credit report. So it's not hurting them, if that makes sense.
No, it makes great sense, especially if they're looking to either access more credit from different sources. That not appearing is obviously an aid.
Exactly. Yeah. And what's really cool about this, Jeff, one thing COVID did for us is everything is sped up. I mean, we're freaky fast at what we do. So, for example, a client can we could send them, quote, the link, and they answer 5 questions: name, phone number, email, how much money they're looking for. Click submit. Takes them into an intake form, not an application. Takes about 15, maybe 20 minutes to complete it at the most, and some people do it in 10 minutes. Anyway, long and short is once they click submit, we literally will underwrite that file in 90 minutes to 4 hours. We will have same-day answers with rates, terms, conditions, 3-year, 5-year, 7-year, 10-year options, the whole bit, all done digitally. We'll have an email with everything in it. If they say, yep, tell me more, then we assign one of our sharp reps to it, Linda, James, etc., and they'll contact the client, get all their questions answered, get the documents done, and literally that money is wired into their bank account 3, 4, 5 days. And from inception to cash in their account, 7 to 10 days.
And these are really unsecured loans, is that right?
Absolutely 100% unsecured.
Wow. It always fascinates me that whatever you're looking for in terms of collateral or justification by which this would be a good loan, and you make them, and you've been making them now for, I don't know, how many years we've been talking about it on the phone?
Right. A few years now, yeah.
Yeah.
Our clients are great. We've got great relationships with funding sources, great relationships with the clients. We have a less than 1% default rate.
Now, that's absolutely fantastic. And you're saying that the best way to actually get involved with this is to fill out a form, send an email. Where do they go?
Yeah, well, what we can do is, let me give again, for you, Jeff, we always do this. I'll give everybody my personal phone number.
Good, great, thank you.
That number is 801-830-6240. Again, that number is 801-830-6240. Now, if they give me a call, I will actually jump on the phone, answer any questions they may have. I will literally send them the link and or do it right on my phone. I just type in their phone number, and boom, they get the arrives on their phone.
Because they need the security blanket, or what is it that are they investors? Are they real estate people? Who's coming to you?
Yeah. The more people come to me that come from the real estate space. But again, we can use it for any business of any type, shape, or form. I mean, you name it, we've done it. Mobile taco places to cannabis operations to home-based businesses, people doing MLMs. And it can be used by anybody. And a lot of our real estate line of credit people use it to make sure they've got their cash for their skin in the game money.
No, I understand that. And you're saying the rates are market-driven, whatever the market bears that day? And what does that mean?
Whatever the market rates are. Yep.
Oh, I see.
Whatever the market rates are, 6 to 11%. Again, it depends upon the profile of the client.
I see. Obviously, the stronger the client, the cheaper the rate, I guess, is what you're saying.
Exactly.
Yeah.
And the term. They choose a lower, shorter term, just like a mortgage. It's going to be a lower interest rate than a 3-year term is going to be less than a 10-year term.
I see. Okay, so obviously you're excited. Are you excited about what's happening, even though we get this constant upheaval from people afraid of whatever's happening health-wise to the country, to the world, through COVID or whatever, and the markets get really pushed around quite a bit. Whether the stock market will drop 1,000 points or whether interest rates go up and down. Does it affect how you guys do your business?
No, right now, no. Right, my attitude is get the money while it's there.
Yeah, okay.
Don't get caught in another COVID situation where it disappears or, wait. In fact, with our real estate line of credit, Jeff, that's really where we're positioning people. We have that real estate line of credit starts at $500,000. It goes all the way up to $10 million. Now, that's a line of credit. So when a client gets that money, that's theirs. They're not chasing around hard money or whatever.
Right.
They've got it. If we tell them they've got $700,000, they've got $700,000 to work with. And a lot of our clients, we're positioning them saying, what would it have been like if you had $1 million in 08?
Right. You're right.
What could you have taken advantage of?
No.
What's amazing about this, real estate line of credit program is you only, and it just blows me away, we're just killing it with this. You only have to have a mid score of 640 or higher, and you'll qualify for this loan. You'll be approved.
Wow.
640 or higher is the mid score. It doesn't matter which one. In the last week, for example, I helped somebody get approved for $500,000, $600,000, $1.15 million, and $2.475 million for real estate lines of credit. Now remember, this money, unlike the unsecured, this money can only be used for real estate. But they can do anything with it. Fix and flip, buy and hold rentals,
right.
Airbnb, new construction, raw land. You name a real estate category, they can use this money for it.
Reed, we're up against it, brother. Hey, man, we're up against the clock. No problem at all. I could talk for a while, but we just got a commercial break, and I really appreciate you coming on the show. Shout out how people can get in touch with you one more time, please.
All right. The phone number is 801-830-6240. Again, that number is 801-830-6240. And on that relock, 1 day for approval.
Wow, that's awesome. Reed, thank you very, very much for coming on the show.
No, thank you. It's always an honor and a privilege to be on your show, Jeff. You're terrific.
Excellent. Thanks. That's Reed Blake, Foresight Funding Advisors. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back. Our show here, The Mortgage Voice, is available whenever you need information, even if you need it right away. To fit your busy schedule, of course, we make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly program also available on YouTube. Podcast form, wherever you need it. Our podcasts, including Apple and Google Podcasts, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in, for listening to us. We usually have terrific guests on the show, bring to you information that you may not get anywhere else. Mortgage shows by themselves are pretty stale. We try to keep it fresh by linking it to all kinds of things that you may not have thought about, how it affects both your interest rate as well as the availability of funds. Availability of funds, that is a key term. You know, we're still not back to the level of funding that we were prior to 2008. Yes, that's true. And as a result of that, we've had all kinds of demand on money, even though, interest rates are cheap, right? But the criteria to get the loan has not really lessened. It is actually pretty strict. You still have to have the right credit score. You still have to have, obviously, the ability to repay the loan. You have to have many things in place, and the check and balance on what you submit is more stringent than it was then, and obviously it restricts the easy money that was available, obviously, in 04, 5, and 6. We all know what happened with them. People ask me all the time, they say, well, what about, the real estate prices going up, and how come there's nothing available, and aren't we just feeding into a housing bubble? Well, I don't know enough to be dangerous other than to say, look, the loans on the front end are strong. FICO score is averaging over 700. Most people have money into the deal, especially with purchase, and the criteria is tough. It is not simple. You have to prove your ability to repay FICO scores, as I mentioned, as well as provide the documentation needed to prove everything you say. I was into as broker for Malibu Funding. Malibu Funding is a sponsor for the show. They pay my salary, and I'm very grateful to them, and I thank you. Their NMLS is 79620. So in order to, represent them, I go into all the major lenders around the country's websites, and I have ways to get into the inner workings and look at each file that we do. And looking at the files, it's amazing the documentation you need. It's amazing the amount of stuff that you have to prove not only that you can pay, but that ability to pay will go for the length of the loan, whatever the loan is, and that you can afford the payments. There are strict DTI requirements, income requirements, and the documentation goes on and on. Now, automation has helped the mortgage industry get faster, but faster doesn't mean weaker. It doesn't mean less than. It actually means, no, we have a great many eyes looking at each department upon these loans, not only underwriters, but document collectors and funders, people that look at the file to sell in the secondary market prior to that happening. Secondary market is usually, as everyone knows, Fannie Mae, Freddie Mac, or FHA. All of these, Ginnie Mae. And all of these are there to protect you. So when they say, is it going to happen? I would say, like I say, I don't know enough to be dangerous, but I do know what I see, and what I see is really strong loans from people who can afford to pay, from people who have long-term employment, and the FICO score to prove that they are good to go. And that's a good thing, I think, as a good thing. Now, speaking of 2008, speaking of a lot of things that happened to us, both here where I record the show in California, but across the country, the perception of what's being said is really the reality of how you live on your daily, right? So if I say, look, interest rates are going up, people get nervous, i.e., 7.5% last quarter, the originations went up, okay? And that's from a year ago. It took me a minute because there are so many different ways that you can say originations. You can say sales, you can say closed sales, you can say, again, originations. But because of the fact that people said interest rates are going to go up. Now, they were going up, but they weren't going up to the tune of 7.5% new mortgage originations. But they did so because people believed in what they heard and went out and did something about it. Now, we all know today, of course, mortgage rates are back down because other world events occurred. Now, in certain areas, we look to that. We had a loan recently, and we looked at what the borrower wanted to do. The borrower wanted to pay a certain amount of money for the house. Why? Because they just wanted the house. The seller said it was worth a certain number. Let's call it $700,000 in Las Vegas, okay? The appraisal came in at $600,000. The appraisal in Las Vegas for a house being sold at $700,000 in the agreed upon contract was sold. The appraisal came in $100,000 less than what it was sold for. Now, why did a buyer pay that? Because they were told there's not a lot on the market. They were told that this is what it was worth. They were told that certain things in a particular deal had to be met in order for them to get the price, in order for them to get the property. All three of those things were wrong. So what happens in situations whereby you are so influenced by what people are saying that you go out and you pay $100,000 more than what the property is worth? And conversely, they can't get a loan on it because obviously no lender is going to lend on what the purchase price is. They're going to lend on what the appraisal is. Actually, most lenders will lend at about, 75 to 90% of the appraised value. So it's even less than that. So the buyer now has to come in with $120,000. Now that's a big number, right? If you're not expecting it. So what do we do about that particular thing? There's a great article by Ben Smith. You can look up Ben Smith. He talks about the perceptions. Now, granted, he's not talking about the mortgage market. He's talking about the political spectrum because it sells, right? It gets clicks and blah, blah, blah. And he admits it himself. And there's a number of people who talk about the perceptions in the marketplace versus what is real versus can we agree upon anything that's real. In the mortgage space, it's easy enough because we can look to 1,000 websites, the Fed and the Treasury in the U.S. to see what the rates are. These are the rates. Everybody can agree that this is the rate. Okay, today, 3.21% for a 30-year fixed. We can all agree that within 10 or 15 basis points either way, this is what the 30-year is. But when it comes to the subtleties of what drives market rates, the availability of funds, and that's actually way more important than the rate. Because you can have a 1% mortgage, but if there's nobody who'll lend you the money, what's the difference? You might as well have a 100% mortgage. The availability of funds. And who controls that? Mostly it's the Fed and the Treasury in the U.S. And they control that based on whatever they see as the headwinds down the road or the tailwinds that they need to catch in order to make sure that everybody's employed, number one, that the inflation rate isn't out of control, number two, and certainly that the money is available to those people who can afford it. Now, we've had periods over the last 10 years, over the last 2 years, where that was beginning of COVID. COVID hits March 15th, 2020. Boom. The next day, availability of funds was zip, even though the interest rates weren't too bad. You couldn't get a loan. Why? Because nobody wanted to risk the fact that how are you going to prove that a borrower can borrow money? If somebody's lost their job this week, how do you know if they present you pay stubs from the last week, which is this week, that they're going to be employed next week? All of these risks that the lenders had to take on meant that the availability of funds went to almost zero at that time. Now, let's jump forward to today. We have the new coronavirus variant. And that variant has spooked the financial market so much that you've seen the stock market dip 1,000 points last week, 500 points this week. Those are big numbers. Now, granted, not everybody's in the stock market, but the sentiment in the community is that, what's going to happen? So again, because of the fact that people get afraid, is that based on the truth of what's happening? Is it based on what people are saying is the truth of what's happening? And in most cases, it really depends on who's talking to you. If you talk to a guy like me, I'm going to say, hey, interest rates are pretty good. I can show you and prove to you what the interest rates are. I can't predict what tomorrow's going to bring, and I can't predict whether you're going to keep your job, but based on current situation, I can tell you exactly whether you can get a loan or not. And that's the truth in that particular business, which is why a lot of people like real estate, because it's something you can grab, you can sit at, you can go home to, and you own it. And I pay X amount of dollars for the next 360 payments over the next 30 years. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. We'll be right back. This is the Mortgage Voice, and we are available on demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately on YouTube. Hey, we upload the show every week, and every week you can go there and find it. We shoot it for video, and we have audio. Just search for the Mortgage Voice, and you can also listen to the show on demand on your mobile device via any of our podcast partners, Apple, Google, Spreaker, iClips, Spotify, Stitcher, and more. Plus, we are still available on traditional radio. That's right, I love some radio in a number of different markets, including those in the Inland Empire, California, Las Vegas, Albuquerque, New Mexico, and Lake Tahoe. So tune in. And again, I'm Jeff Barton. This is the Mortgage Voice, and thank you for listening. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, you hear this show today. You're on the radio, wherever you're hearing us. We're in 5 different radio stations in 3 different states. But if you go to YouTube, you can see Jeff, too. Jeff Barton, the Mortgage Voice. We have about 200 shows there. We also are on LinkedIn, Facebook, Instagram. We do some about 2-3 times a week. I jump on there and talk about what's happening that day. And my Twitter feed is at Jeff6493. 6493 was a license plate I had in Massachusetts about 150 years ago, and it just stuck with me. So appreciate you listening. We bring to the show many, many great people. People who know a lot about what's going on, not only locally, but nationally. And one of our true go-to people in the real estate world is Phil Burson. He works for Compass, and he joins us here. Phil, how are you?
Doing terrific, Jeff. How are you today?
I'm great, thank you, and thanks for coming on. Thanks for doing the show, as always.
My pleasure.
Okay, tell us something about what's happening in your local market. Tell everybody where your local market is and what's going on in the real estate there.
Yeah, sure. I am in the Calabasas, California, west of the San Fernando Valley. The real estate market is still quite active over here. Not enough homes available for the number of buyers that we have. It has lessened just a little bit from the height of the market and all the people searching for homes over the last year. With that being said, we still are seeing multiple offers and final sales prices over the original asking price.
Hey, I was talking earlier on the show. There was a deal in Nevada. And it went for, the sales price was $100,000 more than the appraisal price. Are you running into any kind of issues like that in your sales?
We are absolutely, on the average, 5 to 10% over the sales, over the asking price. As you know, with appraisals, they are based on comps, so it's past transactions. The homes that may have gone into contract 30 to 60 days ago that are selling now. So there is a lag time there.
Right.
We are seeing some appraisals actually being waived by the buyers.
Do you negotiate that up front, Phil, or do you wait until the appraisal comes in before you deal with any disparity?
We try to negotiate that up front.
Right.
We're trying to set the tone, and when we choose buyers that may be willing to follow through with their closing, even if the appraisal comes in a little bit low.
And in that case, and they're having to bring more cash in, do you see any concessions yet from sellers, or is it still a huge seller's market?
Still a huge seller's market. You're right, Jeff. Typically, if the appraisal comes in low, the buyer will have to come to the table with more cash. But we are seeing a lot of buyers actually waive that contingency, and in order to get their home winning the bid, it's what they are willing to do.
You know, in a lot of parts of California, certainly in certain times of the year, there are huge fires out here. Are you having issues getting fire insurance for your clients? Because I know in certain other areas of the country where the show is, it's more about flooding or it's more about other, weather-related issues. But out here, a lot of it's fire. You having issues with fire insurance?
No issues per se. However, California Association of Realtors did just come out with a new form and a new disclosure and signature regarding the fire hazard safety zones. So insurance can give you a quote, and there are certain very high risk and high risk areas that we need to address. Fortunately, we haven't had big fires in the last couple of years.
Now,
but still an issue.
You being a very experienced realtor, there are so many forms. You ever get complaints about the thousands of forms that the buyer or the seller have to fill out? I mean, again, we had another instance where a buyer was like, I just signed everything the guy gave me. And I'm like, no, you can't do that. You got to read them. What kind of resistance? Now, I know this is sort of mundane, but how do you handle that when you're talking to your clients?
We try to be there to guide them through the forms. Yes, there's a plethora of forms. There seems to be more and more all the time.
Yep.
But we are trying to automate them as well. To our company, Compass, we're incorporating certain systems like Glide that we send a link and we can actually fill out the forms online without having to print, sign anything. And it takes them tab by tab through the questions and gives them all the explanations. And as an agent, I'm always here to answer the questions for our clients.
No, I like the fact that that's like a DocuSign type of form where you just fill it out online and you can do it at home. And if you have questions, call the agent. But it's done. Like you say, you have a copy of it in your electronic, whatever folder it is, and it gets sent around to where it needs to get sent around pretty fast, right?
Absolutely. From person to person, it's right there. So our clients, the buyers, the sellers don't miss anything. And us as agents, we don't miss anything either. Now, it's all about compliance and disclosure.
Of course. And I think, as you said, there's more and more forms all the time about disclosure. You just mentioned one from the California Association of Realtors. How much is really on the buyer themselves or the seller themselves? It seems like the forms are designed to prevent, agents from getting in trouble by not disclosing. So they come up with forms to say, no, we disclosed it. But is that how it works?
It's both the buyer, it's everyone involved. I mean, yes, the forms are drawn up by the attorneys for the agents, but it's also to protect the buyers and sellers. So to the best of their knowledge, they answer the questions, and again, it's all about the disclosure. But it's all to prevent lawsuits and fraud between all principals in a transaction.
I see. Now, Zillow. Were you happy that they got out of the... I laughed too. Yeah, we talk about it a bit on the show and how this iBuying scheme or scam, I mean, anybody who looks at Zillow first before they price their house are doing them a disservice because they're usually overpriced, and apparently they believed in their own press because they're now out of the iBuying business.
Yes, it's quite ironic. So much value is being put on their estimates, and then Zillow themselves overestimated values, and now they're in trouble and selling billions of dollars worth of products. So, again, it all goes back to getting in touch with your trusted, actual neighborhood realtor who knows the market, that can give you a real opinion, not an opinion value, but an estimate of value based on facts, not on computer-generated numbers.
Yeah, I like that. That's a great explanation for it. I think relying on people in a people business, which real estate is, and it's local. It's not like I can sell properties in Alabama. I don't know anything about Alabama, but apparently the algorithm thought, no, we can use this anywhere, when you can't.
That's absolutely right.
Hey, buyers or sellers, what's your preference, and what are some of the challenges you're facing today with a lack of property on the market?
We prefer to, we work with both buyers and sellers about 50-50 right now.
Okay.
Working with buyers is always exciting and satisfying, especially first-time home buyers, getting them in their first property and see them, grow their families and obtain wealth through real estate. On the other end of that is the sellers. We have a lot of older sellers that are selling off their properties. They're moving out of state where they can get from California a lower cost of living and live a little bit easier, and help them with the transfers of wealth. And that's a big thing moving forward is the generational wealth transfer. So that's something we're paying a lot of attention to right now.
Yeah, I like that. I like the fact that although California, there seems to be a lot of people leaving California, but at the same time, we don't see prices of houses coming down, nor more houses on the market. So I don't know how that works.
And there's still, with everyone that's leaving the state, there's a lot of people that have the dream and come out here for opportunity and beautiful weather, sunny and 80 degrees, heading into December 1st. So that's what people pay for.
Yeah, it's funny. I was at the supermarket the other day, and a guy, obviously, who wasn't from California said, "Hey, is it always this hot this time of year?" And everybody around him started laughing. I go, yeah, you're new here, right? It's California weather is just like that. Absolutely. Hey, Phil, could you shout out a way by which people can get in touch with you if they need a terrific agent in the Calabasas, San Fernando Valley area of Los Angeles, California?
Yeah, appreciate that.
Sure.
Barton Group, www.barsongroup, BERSON, group.com, or 818-425-7757.
Phil, thanks very much for coming on the show. Love the information and the enthusiasm about the business. Really appreciate it. Thanks very much for listening. We'll be right back. Our show here, The Mortgage Voice, is available whenever you need information, even if you need it right away. To fit your busy schedule, of course, we make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly program also available on YouTube. Podcast form, wherever you need it. Our podcasts, including Apple and Google Podcasts, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Hello, everybody. I'm Jeff Barton. Welcome back to the show. This is The Mortgage Voice, and again, I am Jeff Barton, and we are here every weekend. We're on a number of different markets. We're on the radio, and if you want to hear us on those radio stations, you can turn into Albuquerque at K-Mine Country. Isn't that what it is? Of course it is.
That's exactly what it is.
Exactly. And in Las Vegas, it's K-Ship, KSHP. Up in Tahoe, it's K-Tahoe. In the Inland Empire, it's KMET and KCAA. 5 stations, 3 different states, and we probably reach a good portion of the interested mortgage consumer out there in those particular places. We've been on quite some time, still looking for a lot of new outlets for the show. We've added a number of different podcast, and podcast seems to be the watchword for anybody under a certain age. If I say, hey, I'm live on the radio, they say, well, where can I hear your podcast? And of course, it's 2 different things, but yes, we have podcasts too, and we're on 8 or 9 of them. Daryl, do you have a couple of instances where...
A couple to mention?
Yeah, exactly.
Yeah, I do. Apple Podcasts, we've got Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
Podclips.io, great place to see others as well as us in the finance section, health, sports. Great place to go and find other podcasters like myself. Given that's the best way to get a hold of us and see us, you can also reach me, Jeff, at Jeff6493, that's my Twitter handle. TheMortgageVoice.com, that's our website where we also do blogs, and you can see the guests on the show. Yeah, we got a lot of good things, many ways that you can hear us, see us, and get educated about mortgages. Some of the things also in the news today, the conforming limits rose, which is a good thing, and Fannie Mae and Freddie Mac are going to start accepting loans up to $1 million. What does that mean? It means if you want the best rate and you have great credit and a good amount down in whatever the conforming is, conforming loan at your lender, you will be able to sell up to $1 million to Fannie and Freddie, which means you're going to get the best rate. And the best rate for a good client like that is still pretty good. What did I quote it today? 3.13 on a jumbo. That's smoking rate, folks. Jumbo loan at that particular percentage, yeah, you're going to have that a long, long time. And anybody out there who's looking to cash out, the interesting thing is, can you cash out? Yes, you can. Do you do a refi on a first, getting rid of that great first rate? Do you do a second loan, take out a second loan? Or you do a HELOC? Any of those three options, these are the times where you have to start asking yourself, inflation being where it is, if I leave the money in the house, am I losing money instantly? Or should I take it out and invest it in a property or some other form of a better way by which you can use that money? These are good things to ask. I do not have the answers, but I do have solutions. If you have a good financial advisor, that's a great place to start. If you have a terrific accountant, a CPA, somebody who can look at inflation as to where it is, where it might be going for the year, and if you have, let's say you have a couple $100,000 equity in your house, is it smart to take out a home equity line of credit at 3-4% and be able to use the money to make more money than the 6% inflation that you're going to lose on that equity in your house each and every year? These are big-time problems that you have to look at, especially, look, how many people in America have equity in their house? Everybody raise your hand. That's everybody. Anybody who's bought a house in the last year, I don't care what you paid for it, you probably have great equity in it. And certainly anybody who has weathered the storm of the last downturn back in 2007, who has held onto that property, paid their mortgage, you've seen a lot of good equity in your house. The credit cards, absolutely you want to pay them down. You want to maintain a great credit score so that you can continue to use equity in your house as we get deeper and deeper into whatever the next year will hold, and we're not quite sure. We talked a little bit about COVID and how that affects your interest rate. Also, let's see. Okay, I talked on our other show on LinkedIn and Facebook and YouTube today, our 5-minute mortgage minute. I talked about profits in the mortgage industry. Now, because there are so many anti-profit people out there in the world, I won't speak to those people because I have my own children, and I think it's true that anybody who's under a certain age who isn't making any money, they're against everybody who is making money who's over a certain age, and I certainly qualify for the latter. But because of the fact that profits are made in the mortgage industry, the argument can be made that those profits should be lessened, and that should lessen fees for the borrower. And certainly, as I mentioned earlier, whether it's CFPB or whether it's Fed regulators or whether it's Elizabeth Warren and the Dodd-Frank Act, all of these kind of people think that, it's somehow the responsibility of the mortgage lender, the mortgage broker, the banks, the lenders, the mortgage lenders to provide not only the cheapest, but also make the smallest amount of money. I'm here to argue the opposite. When companies make money, they are able to offer better products because they don't have to go typically to cutting staff, cutting people. Now, United Wholesale and Quicken, Rocket, two of the biggest lenders in the country. And there's a number of them out there. In the top 10 lists you can go and look at anywhere. They have really made good money in the last 2 years. But the margin from 2.5%, 2.5% of the loan was the margin they were making on each loan. It drifted down in the second quarter of this year to 0.73, about 3/4 of a point. Now, when that happens, the thousands and thousands of people that have been hired by these big companies, the companies have to look at the bottom line and say, okay, we're going to probably lay off some people. Because if it gets closer to a neg or a break even, that's exactly what they're going to do. Because both of those companies are now shareholder driven. They are public companies, as are the top 4 or 5 companies who do loans in the United States. So as that happens, shareholder value becomes more important than employee maintaining your employee base. So those people would get fired. And that's why having companies that make money is a good thing. It's a good thing for you because you get better service, obviously, but you also get better products to be able to offer to you. If that doesn't happen, those people go away and, the shareholders are happy, but you're not going to be able to obviously get the kind of loan that you want to get because there's fewer and fewer underwriters, and that's another thing. There's a huge underwriter shortage. Now, underwriting, you may think, okay, who's an underwriter? Underwriter are the people that look at your loan and approve the loan in order to get funded. But there's also those people who are underwriters who, after the loan is funded, take that loan and sell it to either Fannie Mae or Freddie Mac or the secondary market in some private label securitization. So those particular people are also underwriters. Those jobs are really in high demand. You can make over $100,000 easy being a quality underwriter in each one of those departments, depending on who you work for. Very important to maintain profit margins at least to where they are or were in the second quarter, although they were talking about laying off people if the trend continued. All right, what else is going on? $8 trillion in mortgage originations in the last 2 years. Unbelievable. Think about that for a second. Now, there's $51 trillion in mortgages nationwide right now. $8 trillion of that money, 1/7 roughly, gets turned over in the last 2 years. That's huge numbers. I can't tell you what big $8 trillion. I remember back in 04 and 05 when it was $3.5 trillion per year, and that was like unheard of. Now it's commonplace. Last 2 years, $4 trillion a year, just unbelievable. Let's see. Yes, the Fed said we're going to cut the stimulus faster, meaning that the quantitative easing, QE, or the stimulus will be cut back, maybe not ending in June, maybe ending in April. That is to quell inflation. Inflation is the number one target right now on the Fed's agenda. Whether it's pushed by Biden and his crew, it's good because, holidays, gas prices where they are. Hey, in California, anybody who was out there listening, $5 a gallon. Yep, it's here. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. I really appreciate you listening. We try to provide information that is both stimulating intellectually and also informationally to make you and help you make decisions about where and when you're going to do your mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.